Let's look at this example. It is going to illustrate how we deal with share under subscriptions. We have an example one. We have a company called JS Limited, which was incorporated on the 1st of January 2015, and its year end runs to 31st December of the year. On that day, the company had the following information regarding its share capital. The capital had been issued to the incorporators of the company in 2015 at incorporation. We have got two types of shares. We have got the ordinary share capital as well as the preference share capital. Authorized, we have 2 million shares and we have got 500,000 authorized for preference share capital. They had issued 500,000 ordinary share capital valued at 1 million, meaning that each share was issued at 2 rand. Then there was no preference shares at that time. Now, regarding the issued ordinary share capital, this capital had been issued to the incorporators of the company in 2015 at incorporation. The company approved some expansion projects that required additional financing. Therefore, the directors decided to issue additional shares to the public. On the 7th of March 2016, the following shares were issued to the public on a public offer that ended on the 17th of June 2016. They issued two classes of shares. The types of shares, we have ordinary share capital, we have got the 8% preference share capital. They issued 1 million shares for a consideration of 3 million, that is ordinary share capital. Of these, only 800,000 shares were subscribed, meaning that the offer was undersubscribed by 200,000 shares. Regarding the 8% preference share capital, 300 shares at a consideration of 750,000 rands had been issued, which was fully subscribed. JH entered into an underwriting contract with Specialist Financial Services Private Limited to take up any unsubscribed shares. JH would pay 4% underwriting commission on the total value of the share capital. Further to that, the company will pay share issue costs of 44,500. These were paid on the 17th of June 2016 by the close of the share offering. The directors declared an ordinary dividend of 13 cents per share for the year ended 31 December 2016. Required first part, it requires us to prepare all the journal entries to record all the share transactions that took place between the 7th of March 2016 and the 17th of June 2016 for 17 marks. Then part 2 requires us to calculate the dividends for the year 2015 for 5 marks. We will now go on to part 1, and see how we are supposed to go about it. So now, as at 17th of June, the bank had received 3,150,000, which was received for the application for ordinary shares. So we received 800,000, an application for 800,000 shares at 3 rands each. How do we get 3 rands? The shares were initially issued for a consideration of 3 million, and this 3 million was for 1 million shares, meaning that each share was valued at 3 rands. So as a result, we are now going to say, since they applied for the shares for 3 rands each, and they actually subscribed for 800 shares, which means we simply multiply the 800,000 that we received by 3 rands. That gives us a total of 2,300,000. Sorry, 2,400,000. The other one is for the 8% preference shares. These were 300,000 that were fully subscribed, meaning that we multiply the 300 by 2 rands 50, that gives us 750,000. They were actually issued for a consideration of 750. So to find the value of each share, we simply divide 750,000 by the number of shares that were issued. Then we say this is the receipt of application money from the public. So if we add the two, 750,000 plus 2,400,000, that gives us a total that we received in our bank account of 3,150,000. Then on the close of business that day, it was discovered that the 800,000 for ordinary shares was not enough for the number of shares that were initially issued. The company offered a total of 1 million shares, so there is an undersubscription of 200,000 shares. As a result of the contract, the underwriting contract, they are supposed to get the value of the undersubscribed shares, which is 200,000 multiplied by 3 rands per share. That gives us a total of 600,000 to be received from the subscriber, so underwriter, so that when we add up now the 800,000 that we received from the public and the 200,000 that we received now from the underwriter, it adds up to the initial 1 million shares that were offered. So our bank will receive 600,000, and we also credit the ordinary shares application and allotment account, the same as we did with what we received, the money that we received from the public. So we use this application and allotment account to receive all the monies when the public is applying for the shares. So this is the application, and we also use the same account now to allot to those who are successful. So now the next step is to allot now the shares. We now go and debit the application and allotment account for ordinary shares with a total of 3 million rand. One would wonder, where did we get the 3 million? The 3 million is the total of 2.4 million plus the 600,000 that we received from the underwriter, which is the total value we had actually offered the shares for. Therefore, we now credit the share capital, that is the ordinary share capital, with the value of the shares. This is allotment of 1 million ordinary shares. Notice at first we were just receiving the applications. That's why we're saying receipt of application money from the public. Now we say allotment of 1 million ordinary shares that we have received. Again, we look at the 8% preference shares. We received 750,000. So we debit that application and allotment account with 750,000 to clear the account and credit the share capital, that is for the 8% preference shares, with the same amount. We have now transferred the application monies from the application and allotment account to the share capital account. Now, because we also had a contract with the underwriter, notice the underwriter will be paid the commission of 4% on the total value of the shares offered, not necessarily the amount that they paid for, meaning that if the offer was fully subscribed or oversubscribed, the underwriter was not going to pay anything, but will still have to be paid for the underwriting contract. In this case, the total shares issued were 3 million by 4%. That gives us a commission to pay of 120,000 rands. We credit our bank. Then we look at the share expenses. We are told the company paid on the same date 44,000 for the share expenses. We credit our bank, debit the share issue expenses account. Because the company has not yet this issue expenses are not supposed to be charged against profit. They are supposed to be set off or net off against share capital, which means now we are going to debit the share capital for ordinary shares 120,000, and then we have the underwriters commission 120,000. Now to clear that account and set it off against the ordinary share capital. So this is the underwriters commission written off against share capital. Then we do the same thing again with the share issue expenses. We debit the share capital ordinary shares with 44,500 and credit the share issue expenses account with 44,500. Now clearing the share issue expenses account, writing it off against the share capital. So the first part is now complete for the 17 marks that you saw. Finally, we now look at part 2, 1.2, looking at dividends declared. Ordinary shares, that is cash shares, we have 500,000 that were issued to the incorporators, and then we also have 1 million shares that were issued to the public. So because we need to know the total number of shares that were issued in order for us to calculate the dividends. Remember, dividends are per share. So if we know the total number of shares in issue, that is 1,500,000 shares, at where dividends were declared at 13 cents per share, we multiply 1,500,000 shares by 13 cents. That gives us the total of 195,000 ordinary dividends. When it comes to Class B shares, that is the preference shares, these now are straightforward because they have a fixed each dividend, which is 8% per annum. In this case, we simply look at the number of shares that were issued, that is 300,000 preference shares multiplied by 8% dividend. That gives us 24,000 for the year. Thank you very much.